If you've been following the crypto markets for any amount of time, you know just how wild the price swings can be. One day Bitcoin is up 10%. The next it's down 12%. Ethereum can surge in the morning and crash by night. This kind of volatility can be exciting, but it can also be nerve-wracking, especially if you're trying to figure out the perfect time to buy. And that's where dollar cost averaging, or DCA, comes in. Today, I'm going to walk you through exactly what dollar cost averaging is, why it works so well for crypto, and how you can implement it step by step to build your holdings over time without the stress of timing the market. First, let's start with the basics. Dollar cost averaging is an investment strategy where you invest a fixed amount of money into an asset at regular intervals, regardless of its price. Instead of saving up and investing one big lump sum, you spread your purchases out over time. The goal is to reduce the effect of market volatility on your average purchase price. Some months you'll buy when the price is high, other months when it's low. But over time, you'll end up with an average cost that smooths out the bumps. This approach is the complete opposite of trying to predict the perfect entry point, which, let's be honest, almost nobody gets right consistently. Here's an example. Let's say you decide to invest $200 into Bitcoin every single month for a year. Sometimes your $200 will get you more Bitcoin, sometimes less, depending on the market price at the time. But over 12 months, your overall cost per Bitcoin is averaged out. This means you're not overly exposed to buying everything at a peak, and you also benefit from picking up more when the price dips. That's the essence of DCA. So, why does this method work particularly well in crypto? The answer is volatility. Cryptocurrencies are known for massive price swings in short periods of time. Unlike the stock market, where a 5% daily move is considered big, in crypto, it's not unusual to see a coin move 20% in either direction in just a day or two. This volatility can be terrifying if you put all your money in at once and watch the value plunge the next week. But with dollar cost averaging, you spread that risk over time. You're not betting your entire investment on a single day's price. Instead, you're capturing an average price across weeks, months, or even years. Another big advantage is that DCA removes emotion from your buying decisions. If you've ever hesitated to buy because you thought prices would go lower, or rushed to buy because you thought prices would go higher, you've experienced emotional investing. DCA takes that emotion out of the equation. You're simply sticking to a plan, no matter what the market is doing, and that consistency can be a powerful tool in building long-term wealth. Now, let's go over exactly how to implement DCA in your crypto investing. Step 1 is to choose your asset or assets. This is important because dollar cost averaging works best for long-term investments in assets you truly believe in. For most people, this means focusing on large, well-established cryptocurrencies with strong fundamentals, such as Bitcoin and Ethereum. These coins have the longest track records, the largest market caps, and the most widespread adoption. You can include other large-cap projects if you've done your research and believe in their long-term potential, but avoid spreading yourself too thin across too many coins. 1 to 3 strong picks is usually enough. Step 2 is to decide how much you want to invest. This should be an amount you can comfortably set aside without affecting your daily life or needing to pull the money out in the short term. For example, you might decide on $2,400 for the year. That could break down to $200 per month or $50 per week. The key is to pick an amount you can commit to regularly without feeling pressured. Step 3 is to choose your interval. For traditional stocks, monthly investing is common, but because crypto can move so quickly, many investors prefer a weekly schedule to capture more price points. Weekly or bi-weekly investments tend to work well, but you can also stick with monthly if that's easier for your budget. What matters most is consistency. Step 4 is to automate the process if possible. Most major exchanges, like Coinbase, Binance, and Kraken, allow you to set up recurring buys. This means the same amount is invested at your chosen interval without you having to log in and make a manual purchase each time. Automation is one of the best ways to ensure you stay consistent and avoid emotional decision-making. Step 5 is to track your purchases. Keep a simple record of the date, the amount you invested, the price per coin at the time, and the amount of crypto you received. Over time, you'll be able to see your average cost per coin. This number is useful because it tells you how much you've paid, on average, for each unit of your investment. It's a key metric for deciding when you might want to sell or take profits in the future. Let's walk through a real example. Imagine you invest $100 every week in Ethereum for 8 weeks. In week 1, the price is $2,000, so you get 0.05 ETH. In week 2, the price drops to $1,800, so your $100 gets you 0.0555 ETH. In week 3, it rises to 2,100, so you get 0.0476 ETH, and so on. Over 8 weeks, you've invested $800 and accumulated roughly 0.4232 ETH. Your average cost per ETH ends up around $1,890. That's lower than if you had put the entire $800 in at week 1's $2,000 price. This is a clear example of how DCA can save you money in volatile markets. Now, let's talk about some tips to get the most out of your DCA strategy. First, stay consistent. Skipping a purchase because prices are high or low defeats the purpose of averaging. Second, if you plan to hold for years, consider moving your crypto into a secure wallet, such as a hardware wallet for safekeeping. Third, review your plan periodically, maybe once or twice a year, to see if you want to adjust your intervals or amounts. Fourth, avoid investing in too many coins. DCA works best when you focus on your strongest convictions. And finally, stick to your plan. DCA is not about quick wins. It's about slow, steady accumulation over time. There are also some common mistakes you'll want to avoid. One big one is investing money you can't afford to lose. Crypto is still a risky and speculative market, so never put in funds you might need for emergencies. Another mistake is chasing hype. If you suddenly change your DCA plan to include a coin just because it's trending on social media, you might be buying at inflated prices without understanding the risks. A third mistake is stopping your DCA during a downturn. Ironically, downturns are when you get the most value for your money, but fear often makes people pull back. And lastly, don't ignore the fundamentals. DCA into assets that have long-term potential, not into coins you hope will skyrocket overnight. To sum up, dollar-cost averaging is one of the most beginner-friendly and stress-free strategies for crypto investing. It allows you to steadily build your position over time, avoid the pitfalls of market timing, and remove the emotional roller coaster from your decisions. By committing to regular purchases, tracking your progress, and sticking to a long-term vision, you give yourself a much better chance of success in the unpredictable world of cryptocurrency. If you're new to investing, start small. Choose assets you truly believe in, and let the power of consistency do the heavy lifting. Remember, in crypto, patience combined with a disciplined approach like DCA can be your greatest advantage. So, set your plan, stick to it, and let time and the market work in your favor.